Everyone thinks markets react to events. A war starts, a market drops, an election ends. Stocks move, a rate cut happens, charts explode. That story feels obvious. It's also mostly wrong, because markets usually move before the event. Sometimes violently, sometimes absurdly, and sometimes in the exact opposite direction you'd expect. A company reports record profits. The stock crashes. A central bank raises rates. Markets rally. Bad news hits the headlines. Prices go up. Feels irrational. Feels rigged. Feels like someone knows something you don't. And in a way, that's true. Markets don't react to reality. They react to expectations about reality. And that difference explains almost every confusing market move you've ever seen. Right now, this matters more than ever, because we're living in an economy powered less by production and more by prediction. Prediction of inflation, prediction of interest rates, prediction of growth, prediction of political stability, prediction of fear. So let's slow this down. No jargon, no charts flying everywhere. Just the system as it actually works. Because once you see it, markets stop looking crazy. They start looking uncomfortable. Imagine you're watching a football match. The crowd doesn't wait for the goal to celebrate. They scream when the striker lifts his foot. They gasp before the ball is even kicked. Markets behave the same way. They move on what they think will happen next, not on what's already happened. And that creates a strange world where the future matters more than the present. Here's why. Every price in a market is a bet, not a report card, not a score, a bet. When you see a stock price, you're not seeing how good a company is today. You're seeing what millions of people collectively think that company will be worth later. Next quarter, next year, next decade. The same goes for bonds, currencies, commodities, even housing. Markets are not mirrors of the economy. They're forecasts of it. And forecasts move when expectations change, even if nothing else does. That's where the confusion starts. Let's take something familiar. Interest rates. Central banks spend months hinting, signaling, whispering, and leaking what they might do. By the time a rate hike actually happens, markets have already moved. Not because the rate hike didn't matter, but because the surprise was already gone. In markets, surprise is oxygen. No surprise, no movement. This is why you'll hear phrases like, priced in. It sounds mystical. It's not. It simply means, everyone already expected this. So the price already adjusted. Imagine a shop announces tomorrow that bread will cost double next week. People rush in today and buy bread. The shortage happens before the price change. That's markets. They front-run reality. Now here's where it gets uncomfortable. Markets don't just predict the future. They shape it. If investors expect a recession, they pull back. Companies stop hiring. Spending slows. Growth weakens. The expectation helps cause the thing it feared. This is reflexivity, a feedback loop between belief and outcome. The future isn't just guessed. It's nudged, sometimes pushed, sometimes forced. Let's talk about inflation, because nothing exposes expectation-driven systems better. Inflation isn't just prices rising. It's belief that prices will keep rising. When businesses expect higher costs tomorrow, they raise prices today. When workers expect prices to rise, they demand higher wages. When lenders expect inflation, they demand higher interest. Expectation turns into action. Action turns into reality. Central banks know this. That's why so much of monetary policy is theater. Press conferences, carefully chosen words, awkward pauses. They're not just adjusting rates. They're managing belief. Sometimes a single sentence moves markets more than a full policy change. That should bother you, because it means markets are hypersensitive not to truth, but to narrative. And narratives can be wrong, dangerously wrong. Look at bubbles. Bubbles aren't built on lies. They're built on expectations stretched just far enough to feel reasonable. Housing prices won't fall. Tech will grow forever. This time is different. Each statement sounds logical on its own. Together, they inflate reality. Prices rise because people expect prices to rise. Not because value changed, but because belief did. And when belief breaks, prices don't fall gently. They collapse. Not because the future suddenly got worse, but because expectations finally caught up with reality. Now here's the quiet irony. Markets hate uncertainty, but they love stories. A bad outcome that's predictable is often less damaging than a good outcome that's unclear. That's why markets sometimes fall on good news. Good news can raise new questions. New questions create uncertainty. Uncertainty demands repricing. Repricing means volatility. This is why earnings beats don't always boost stocks. Why economic growth can hurt markets. Why stability can be unsettling. Markets are not moral. They don't care about fairness. They care about probabilities. And probabilities shift faster than reality ever could. Zoom out for a moment. This expectation machine didn't always dominate the world. Decades ago, markets reacted slower. Information traveled slower. Predictions were fuzzier. Today, expectations are updated in real time. Algorithms parse speeches mid-sentence. Headlines move billions in seconds. Rumors travel faster than facts. Markets aren't waiting for confirmation anymore. They're trading on anticipation of anticipation. What will others think others will expect? That's not a joke. That's the system. And it creates fragility. Because when everyone is positioned for the same future, any deviation becomes explosive. A slightly hotter inflation print. A single unexpected vote. A minor geopolitical shift. Small surprises in expectation-driven systems cause big reactions. Not because the world changed drastically, but because belief did. This is why crashes feel sudden. They're not sudden. They're delayed. Pressure builds quietly as expectations stretch. Then one moment breaks the narrative. And the unwind is brutal. Here's the part most people miss. Markets reacting to expectations isn't a flaw. It's a feature. It allows capital to move before problems fully materialize. It rewards early information. It encourages planning. But it also rewards confidence over accuracy. The person who confidently predicts the wrong future early can profit more than the person who correctly predicts it late. That should worry you, because it means markets don't always select for truth. They select for persuasion, for timing, for coordination, for narrative control. That's why central banks obsess over credibility. Why governments fear loss of confidence more than bad data. Why sudden trust shocks cause disproportionate damage. Once belief cracks, the math accelerates. Interest rates reprice. Currencies move. Debt becomes heavier. Refinancing dries up. All because expectations changed. No factories burned down. No skills vanished overnight. But belief did. And belief is leverage. So where does this leave you? It leaves you living inside a system where prices tell you less about today, and more about what millions of people think tomorrow will feel like. It means headlines are often backward explanations for moves that already happened. It means the most important economic events are often psychological before they are physical. And it means stability is fragile, not because reality is weak, but because expectations are tightly wound. The next time you see markets move in a way that feels irrational, ask a different question. Not what happened, but what belief just changed? Because markets don't trade facts. They trade the future. And the future, by definition, is never settled. Which raises an uncomfortable final question. If prices are driven by expectations, and expectations are shaped by narratives, who controls the story we're all betting on?